Hello and welcome to this week's Fit Finance Sessions with myself, Tom, and my fellow comrades in all financial planning needs, Henry and Tim. Now, the Republic of Financial Planning has some rules around gifting, and often those are often misunderstood in terms of what you can gift and whether there's tax to pay. So we're just going to do a quick episode on what exemptions you have, what can you do, what can't you do, and hopefully that fills in some of those gaps. So Henry, before we get onto the bigger gifting rules, what are the main small exemptions and bits you can do day to day that often get forgotten about?
Sure. So the first obvious one is your annual exemption, and so every man, woman, and child in the country is allowed to give away £3,000 a year from their savings, from their capital, to whomever they want to give it to. And the great thing about this is that they can also go back a year, and so if they didn't give away £3,000 last year, they can carry that forward to give that away. So potentially £6,000 a year. So that's a really useful one, and one that needs to be taken into account if we're looking at some of the bigger gifts that Tim will talk about, is using that as part of the bigger gifts amounts. But there are some other ones too. When people get married, if you're their parent, you can give them £5,000. If you're still married, your spouse can give them £5,000. So that's well, actually, you don't need to be married still, but that means that there's a potential to give away £10,000 to your children, and for your grandchildren, the allowance is £2,500 each. And actually, then there's another allowance, although I've never met anyone who's generous enough to do this, of £1,000 to anybody on their wedding. When I got married, no one liked me enough to offer me that, but we did put a Bentley on the wedding list. But I suppose that's more than £1,000, probably why we didn't get it. On top of that, you can then make £250 gifts to as many people as you want every year. So this isn't in addition. So if Tom were to give me £3,000, he can't then give me £250, but he could just give me £250 if he wanted. Again, Tom hasn't offered that. I'm not sure if he has the inheritance tax liabilities yet. The other allowances are to charity. You can give as much money as you want to charity without any issues. And political parties, they're quite happy for you to give them any sums of money that you want, and immediately reduce the value of the capital value of your estate, which is probably unsurprising.
We'd also recommend only doing that if they're going to do you a favor in return as well.
Yeah, well, that's right. So make sure it's a significant donation and that the papers all know about it, so it's well publicized. And then on top of that, the one possibly that's most overlooked is the regular gifting that you can make from your income. So if your pension, but I mean we see this with doctors or people with defined benefit pensions, if their pension income is more than they need, you can give away that surplus income. And all that really needs to be shown is, one, that it's coming from your income, i.e. your capital pot isn't having to be depleted to continue this payment. And secondly, that it's made regularly. And by regularly, probably at least annually, this gift is made. And if you do that, it falls out of your estate right away, which is really great. It saves you having to save money up and then give that money away to use those other allowances that I discussed earlier.
Yeah, and that's the same principle why life assurance premiums are free of inheritance tax, because it's a regular amount. And just adding on the charity, but if you do leave more money in your will to charity, then you get a reduced inheritance tax rate if you leave. Is it more than 10% of your?
More than 10% in your. The threshold gets, not the threshold, the rate gets reduced from 40 to 36%.
Yeah. Okay, great. Tim, why don't you explain the two main types of gifts when you go outside of those exemptions? So you can make bigger gifts. There's two main types, but why don't you explain to our wonderful viewers what those entail?
Absolutely, I'm happy to. So yeah, as soon as you go over those allowances that Henry's gone through, then I suppose the easiest and most easiest to understand is gifting to people, so ignoring anything else for the minute, gifting more money than what Henry's just gone through over those allowances to people, is that money suddenly becomes what's called a pet, not your fluffy rabbits and your dogs, etc. But a potentially exempt transfer. So essentially, what that is an earmarked value. So let's say you gift your neighbour £100,000. It doesn't become a problem as long as you survive 7 years. So effectively, that if you were to pass away within the 7-year time frame, then that 100,000 effectively comes off your nil rate band, which is £325,000, reduces the value of your estate. That can pass on to whoever you're leaving it to tax free. And so that's why it's called potentially exempt, because it's potentially exempt as long as you live that through that period. But if you don't, then there could be some issues to come into play. Now that said, there is an additional relief called what's called taper relief, whereby they give you a bit of a break if you live at least halfway through when you get closer to the 7-year break off point. So that relief starts to come in after surviving 3 years. And then gradually gets better and better as you get up to the 7-year time frame, and then obviously 100% relief from that point forward. So that's it in terms. Well, number one is this potentially exempt transfer. There's PET, and number two is what's called a CLT, a chargeable lifetime transfer, and this is specifically mainly referring to gifts into trust, or specifically relevant property trusts. Which, to be honest, most trusts, which most families set up are what's called a relevant property trust, i.e. your family trusts, your settlements, that sort of thing. And that effectively is where it doesn't become a pet, and you are restricted to your nil rate band as to how much you can gift in every 7 years. So to be clear, a pet you can gift as much money as you want. You just have to live past that 7-year period. But with a CLT, if you go over that £325,000 nil rate band, then essentially there's a 20% inheritance tax charge, lifetime charge to pay on that excess that goes over there. And that's typically what, as I say, what normally comes into play when you're gifting into trusts. So when people are looking, if anybody is listening to this, full stop, but is and looking to gift money into a trust, then just be careful of that, because of course you could be creating yourself some tax, which most people don't want to be doing. So yeah. And
if you're listening to that and thinking, well, why on earth would I gift into a trust when I can make a pet of unlimited value? The main reason I don't gift any money to Henry is he would spend it all down the pub. So with a pet, there's no control afterwards. Whereas if you gift money to a trust, then you can control potentially how that happens over time, or put parameters around it, depending on your situation. It's probably a bit too technical for this update. There is sometimes a better order in which to do all of these gifts. So if you're not quite sure and you're thinking about doing gifts, speak to us. We'll explain how to make the gifts, how to make them in the best way, how to structure them to achieve the right outcome. And equally, there's lots of small things you can be doing which are easy to do and often forgotten about. So thanks for tuning in. And if you need any help, then speak to us. Take care. Cheers. Bye.